Good morning, everyone. Can I get a quick mic check? Make sure everything's working. I am recording this. Yes, I am. There is no intro music because I had to reset my streaming software to use a couple of different screens, and I just didn't get it pulled together in time. Sorry about that. This is the 11:30 gamma exposure presentation that I've been promising you guys for, I don't know, feels like about a month. The last couple of weeks have been crazy busy for me, so now I'm just settling back in and thought we would get through this presentation so that when we talk about it in the room, there's just a little bit more clarity. Now, this is a pretty in-depth concept, and I'm not going to go deep into the weeds. I'm going to give kind of a little bit of a higher overview because if we go deep into the weeds mathematically, it just gets really confusing and potentially boring, and my brain starts to hurt. So, and I would assume that your brains are also would also start to hurt. So, we're just going to kind of go through this on a high level and talk about how we can use gamma exposure to trade. And I'm going to trying to organize my screen a little here so that I can still see chat. So let's do this. That should be good enough, right? Okay, so let's get ourselves rolling. So why is GEX important, right? GEX stands for gamma exposure. It's just a short way to say gamma exposure. GEX is like volume profile for the options market. And in this room, we all use volume profile pretty extensively when we're trading stocks and looking for levels in the market. And GEX is exactly like that for the options market. It actually has a little bit more of a predictive element to it, which is interesting, and we'll get into in a little bit. It maps where the largest concentrations of options exposure sit, and it shows price levels where market makers' hedging activity is most likely to influence price movement. And so getting to know where market makers are going to react is really important in the options market, right? This is what a gamma exposure chart can look like. And we'll get into that here in a little bit. We'll get deeper into the weeds on that. Yes, I am recording this. So we all know what a market maker is, right? When retail or institutional investors are placing trades, like us or large institutions or hedge funds, market makers step in to take the other side of the trade, right? There always has to be somebody on the other side of that trade to execute those orders. So if you're buying a call, they're selling you that call generally, right? When you're selling, they're buying, right? It's just there's a constant give and take, and they're taking the opposite side of that trade. So their job is to provide constant liquidity in the market to keep markets moving. And they profit from the bid-ask spread, and they dynamically hedge their positions to manage their risk. And we'll get into kind of how they hedge those positions in a minute. And because of the options popularity, especially in the zero DTE market, since sort of COVID, the growth has kind of happened since COVID. A lot more people, a lot more retail investors like us are playing options and not just playing the stocks. And with the advent of a lot more zero DTE instruments and a lot of SPX type XSP style instruments that have zero DTE options, has just grown exponentially, right? So the average daily contract volume for U.S. options soared from about 29 million contracts before the pandemic to roughly 43 million contracts in 2023. And at the moment, Zero's DTE volume accounts for about 43% of all S&P options daily volume. So if options is such an important part of price action, wouldn't it be advantageous for us to be able to see where those key levels are, right? So market makers are always hedging, right? Because they're taking the opposite side of every trade. For the most part, obviously, there's buyers and sellers in the market like us. That's we could be taking the other side of another retail investors trade, but generally, the market makers are doing most of that work. And to do that, they need to hedge their positions, right? And they do that by staying delta neutral, right? So they're buying or selling shares to offset the directional risk that they're taking, right? When they take the opposite side of an option trade, they're going to buy or sell the underlying stock or other options to keep themselves delta neutral, right? It keeps their portfolio balanced, and they're profiting from the spread and the volatility in the middle of that. So most of us know options pricing. It's very dynamic, right? It's driven by a lot of different factors, and the most important factors are the Greeks, delta, gamma, theta, and vega. They're constantly shifting the price and the value of an option, but even when the price doesn't move. And when we're talking about GEX and we're talking about looking at how GEX, how gamma exposure affects the market, we're going to look at both delta and gamma. We're not going to talk about theta and vega. We can get into those in another presentation if we need to. Theta is, your time decay. That's another important one when we're talking about zero DTE options or close to expiring options. But that's another day. So what is delta? We should all probably know what delta is, but if you don't, delta is the amount an option price is expected to move based on a $1 change in the underlying stock. So a delta of 40 means the options price will increase by 40 cents for every $1 rise in the underlying stock. Now, we typically buy at the money options generally, or slightly in the money options. And so you'll see and hear us, like if you're doing Nate's TPS style trades, you'll see and hear us, we're buying the at the money, or we're buying the 50 delta or the 55 delta options because we're getting a better price, and we're getting about a 50% move on those options. And every option contract is 100. It represents 100 shares of that stock. Oops. Sorry. There we go. So how does the market maker stay delta neutral? So let's say the market maker sells one Apple call when Apple is trading at $195, right? So they're selling a $200 call, which has a $195 when Apple is trading at $195, and that call has a delta of plus 40. Right, so to stay delta neutral, once they do that, they'll buy 40 shares of Apple. Right, since one contract equals 100 shares, they're offsetting that by buying 40 shares. So then, if Apple price rises to $198, right, the options delta increases to 55. The market maker now has too little stock exposure, so they'll buy 15 more to rebalance. That's sort of the simplest way to think about how market makers will stay delta neutral, right? And so we're talking about gamma. What is gamma, right? Gamma measures how much an option's delta changes when the underlying price moves by $1. Okay? So in that case, if an option has a delta of 40 and a gamma of 0.05, then for every dollar move in the stock, the option's delta will change by 0.05. Okay? So if the stock rises $1, delta increases from 40 to 45, right? Meaning the option is becoming more sensitive to further price movements. Okay? So delta and gamma work together as price moves. Okay? So the best way to describe that is if delta is the speed at which an option price moves, then gamma is the acceleration of that. Okay? Does anybody have questions on that? On what gamma is? So the gamma value is at its lowest when it's furthest away from the money, right? Whether it's deep in the money or deep out of the money, the contracts have the lowest gamma value, and it's at its max value when contracts are at the money. So if we look at a bell curve on that, you can see here when price is at the money, that's when the gamma is at its highest. Okay, and then as we roll out of the money or in the money, it's affecting the price, it's affecting the delta less. Okay, so you can see that here on the right hand side. Delta, as we get deep in the money, moves up and can only go to 1, right? That means that it's moving in a 1-to-1 ratio. Every dollar move of the stock, you're getting $1's worth of value in that option, right? And as you come into these at the money, right, you get your 55 and your 30. You're getting 55 cents per dollar move. And as we move deep out of the money, then we're going to almost no delta value there. Okay. But the difference is gamma centers around the at the money. It's the most volatile, and it's going to move your option the most right at the money. And then it falls off as we go deeper into the money, and then it falls off as we go deeper out of the money. Okay? So you get positive gamma when you're buying options, whether you're buying calls or puts, and you get negative gamma when you sell options, right? Again, call or puts. So market makers, as they're taking the opposite sides of these trades that you and I are making, trades that D-Man is making, trades that institutions are making, there has to be someone on the other side of that trade. And so as they take those trades, they either acquire positive gamma or negative gamma, and that helps them figure out how they need to hedge to make sure that their portfolio as a whole stays delta neutral. So why do they use the gamma exposure instead of delta exposure? Gamma tells them how much their delta will change, not what their current delta is. And that's more important, right? So delta shows the directional risk, but gamma shows how quickly that risk will expand as the underlying moves. And so market makers use gamma exposure to figure out how to hedge, right? And we can also use gamma exposure to help us figure out what we think is going to happen in the market and take trades based on that, right? So gamma exposure lets market makers anticipate how aggressively they'll need to hedge, and how unstable their book might become, and how hedging flows could impact the market, right? So this makes it a far better measure of future risk than delta alone. So how can we read gamma exposure, right? There's a number of ways, and there's a number of services out there that offer gamma exposure charts. But gamma exposure charts look like this, right? You either have a vertical chart where you have, and I'll show you here, you either have a vertical chart where you have call side and put side, and all your strikes are down here, right? And which this to me is vertical, but it doesn't really, you have to flip this in your head to figure out whether this lines up with your chart to give you levels. There are also, there's different styles, and then there's the horizontal style. This one lines up a little bit more with your charts visually, because it's giving you horizontal levels. But you can see all of these are set at, these gamma levels are set at strike prices, right? So they can start to give us support and resistance levels on our charts. All right, so what does this mean for all of us? All of us regular folk, right? We're not market makers. We're not trying to keep our portfolio delta neutral, and we're not trying to use gamma to make sure our portfolio is delta neutral, right? But what does that mean for us? Firstly, on a large scale, and to not, again, as I said at the beginning, to not get into the weeds on, when market makers have this much delta and they have this much negative gamma, so they have to offset by acquiring, this much positive gamma. We don't need to get into the weeds on that, because that doesn't necessarily matter to us, because we're not trying to act like a market maker, right? So on a very broad scale, we can use the GEX environment to help us gauge the mood of the market and the type of price action we might see, okay? So earlier I said, you can acquire positive gamma and negative gamma. So when this affects both individual stocks and overall market when we talk about indices and all that kind of stuff. So in a positive GEX environment, right, it means dealers are long gamma, right? So their hedging works against price movements. So in a positive GEX environment, market makers will be selling into strength and buying into weakness, right? So that's where we get a lot of these types of moves up, right? These types of moves down. Nothing real crazy, because market makers, as the price goes up, they're selling into that move, and then to hedge their positions. And then conversely, when it dips down, they're buying into that move, and it creates a more stable, mean reverting type of environment, right? If you look at yesterday on the yesterday's chart, I'm not going to flip over to that right now because I have a different chart up to talk about this, but we didn't really go anywhere yesterday. If you remember, we basically closed at close to 68.50 the day. I'm talking about the SPX. Most of the things I'll be talking about are on the SPX, but we talk about 68.50 close the day before, and then a 68.50 close was actually 68.55 yesterday. But we were in a positive GEX environment, and that's what creates that just sort of buying and selling and moving around those levels. Conversely, and this is one of those important ones to kind of think about, is when we are in a negative GEX environment, then that means that dealers are short gamma. So their hedging flow amplifies the price movement, okay? So as the underlying price rises, they must buy more, right? And as it falls, they must sell, right? And this is a little like when we talk about a short squeeze. Basically, they're needing to sell into weakness, which creates further weakness, and buy into strength, which creates more strength. Right? When we're in a negative gamma environment, so that basically accelerates those moves down, right? That's where we have those trend down days. And then at the same time, we get those big snapbacks when we come down into a level, and it's not just a tiny bounce, it's a big snapback. So being able to know whether we're in a positive or a negative GEX environment for the market itself and or the name that we're in is really important, right? Do you need me to refresh my screen, or are you talking to someone else? I think it looks okay. Somebody that might be having trouble. To me, you can't see the second screen. You should see a big white screen with negative GEX environment at the top. Okay. So knowing the type of environment we're in is really important, right? That'll help us make, like let's say you do the sniper type trades, right? The sniper 1.0 trades work the best in a positive GEX environment because we're generally staying pretty range bound. I mean, the overall trend could be up, it could be down, but it's going to be smooth, and we're going to stay. If you like to put in trend lines or play in channels, that's when the positive GEX environment is really going to work well on those reversals. Now, when we're in a negative GEX environment, the moves are going to be sharper and longer. And if you're a sniper type trader, that's more of a 2.0 environment, because you're going to get some great 1.0 plays off of reversal levels in that environment, but trying to find those reversal levels is going to be hard. You're going to most likely going to take a lot more stop outs before you actually find that bottom level and get that nice sniper turn. Okay, so gauging the market mood is important. Support and resistance levels are also important. And these GEX levels can act as support and resistance because they are spots where dealer hedging is the strongest. Okay, so as price comes into, remember I said that gamma is the largest, means it's going to affect the option the greatest in terms of delta movement at the money, right? So when we come down into these large gamma levels, put and call levels on the GEX chart, the market makers need to hedge more aggressively near those levels, which creates bounces and rollovers when price reaches those levels, especially if they're a big level and they've been acting as a magnet, right? Which will then immediately slow or reverse that momentum based on the price coming into that level, and we'll talk about that in a little bit. So, for instance, this was support and resistance. This was the gamma chart yesterday, and what I want to call out here is you can see this is yesterday at 9 a.m. Start of the day. Okay. Price is at this dotted line here, okay? And you can see we're right up against this level I've squared here. So that these red squares are ones I've drawn just to point out these two levels, okay? Those are not normally on the chart. We're right at this upper level here at 68.55. And the large lower put level is at 68.30, okay? So what that looks like on the chart, if we put those levels on the chart, it looks like this, okay? And so this upper level here, right, is the 68.50. This level down here was a 68.30. And because we're in a positive gamma environment, we're going to, it would appear from that chart above that if we don't break this upper level here, we're going to stay kind of range bound in here, right? And so this creates support and resistance, and you can see what happened throughout the course of the day. We bumped our heads up against this level quite a few times, right? But always kind of came back down in, and we bounced off of this lower level when we had that huge rollover, not huge rollover, but that big kind of rollover that everybody was like, oh, did we get some news or something? And we bounced right back up. So knowing where these levels are as price action is happening during the day is really important, and being able to use those levels to play. Those of you who were playing snipers, I was also playing snipers, and a lot of these, these rollovers here, this bounce here, they were all great levels to take a shot off of, right? So additionally, another way we can read these charts is as price magnets, right? So price is drawn to large GEX levels because they're pivot points where dealer hedging flows will naturally pull the market towards equilibrium, right? If there's a really high GEX level above price, it's most likely, not always, all kinds of things affect. News will affect the market. General sentiment will affect the market. But if all of those things are equal, we're going to most likely move to very large GEX levels. Okay. You still only see the support and resistance slide. You should be on price magnets now. Does everybody see price magnets? Okay, I'm just going to continue. So since gamma is at the highest at the money levels, right, the market maker hedging becomes more balanced there, and it becomes kind of a gravity that brings that price up. So using yesterday as an example on this gamma exposure chart, this is absolute gamma. So this gets rid of the call and the put side, positive and negative gamma, and it gives us a gamma exposure line that is the absolute. It's called absolute gamma, but it is, you see this largest one right here, right? And we were price at the time this was taken was at 68.60, right? So this is where price currently lives. And this actually, I was supposed to have it on here. This was at, I believe this was at 10:30. I don't know why that little thing got moved, but this was at about 10:30. Yeah, we'll see it on the chart. So, but anyway, we're above price, right? And now we're probably going to have to come down into it because it is the largest gamma exposure level. And if these are both from yesterday, so if we switch back to this chart, we were at 68.55 at 9 a.m., right? So based on this chart, we moved up to, there's 68.55, right? This level is 68.50, right? So by 10 o'clock, we had moved up and just pierced that level that we talked about here, right? So we had just pierced this level here, just ever so slightly when that gamma exposure picture was taken. And you can see that gamma exposure will shift throughout the day, right? So we're up here, and this is our largest gamma exposure level on the entire chart in a positive gamma environment, right? Positive gamma environment there. So the odds are that it's going to come back to that level are pretty high. So here is that same chart stopped at 10:30, right? which is 10:30 my time. Sorry, it's 1:30 in the afternoon Eastern time. That's why I stopped. I was getting confused. I'm like, I feel like this was later in the day, but that's 10:30 Pacific time. So 1:30 market time, and if you draw that 65, what did I say that was? It's the 6850 level in here. That's going to act as a magnet in a positive gamma environment. And so a trade back into that level makes sense. So you see that level, we were here, and now we've come back down through there. But as we came through that level and pierced it, that still stayed on the gamma exposure chart as the largest absolute gamma level. So price came down to the level we showed earlier, bounced up, and kind of came back into that level. And we were talking with Nate that maybe a pin today at 68.50 was the play. This was taken at 3:55 p.m. yesterday as the market was getting ready to close Eastern time. We did get a little bit of a pop up, about $5, but an iron butterfly was still profitable at 68.50, right? Can you not see my drawings when I draw? Really? All right, let's see. Oh yeah. It's because I'm using, I'm centered in on this particular picture. Okay, so when we go to the rest of the presentation, I will, when we go to the charts, I'll show you what I'm talking about with these. Sorry, I didn't realize this one is actually capturing just my window, so I can't draw on it. That's my bad. But I'll show these exact charts, and I'll talk about that here in a second. Okay, so there's a number of ways that we can trade with GEX, and let's kind of go to a couple of examples for today. The first one is today's. Here is this morning's. So this morning, now I'm going to switch you over. So let me know if anything does not come through on the switch. Okay, everybody hear me okay on that switch? Okay, so this was today's gamma exposure chart, slightly after open. So we're probably talking, I want to say this is probably 10:15 or so, right? And you can see this largest gamma exposure level here, right? But at the time, when the market opened today, it was about this level here, right? So this was the largest gamma exposure level, and price was kind of down in here as we came up into this largest gamma exposure level. And we're going to come back to that chart here in a second, right? So this is what we had today, and I'll show you, where are we here? Let me turn this off. Okay, this is where we were today, and if I back this chart up to make this even more easy to look at, right? This is about, why can't I do a replay? Here we go. So this morning, right, I'm looking to play the 15-minute ORB. Everybody can see that, right? Looking to play the 15-minute ORB. And this level here, this 68.80 was the largest call value at that time and was most likely going to act as a little resistance. So I was kind of hesitant to take that 15-minute opening range break because we could reject off of this level. Now that level is this right here, is this one, right? And remember, prior to this picture being taken, this level was lower, right? This level was about here. So this level here was the highest gamma exposure level in a positive gamma environment, right? So what I was watching was if price moves up above that and comes back down in, if that stayed as our primary gamma exposure level, the whole day, we probably just kind of would have done this throughout the day, right? Probably more swingy, but it would have hovered above and below this level here. But what happened as we broke up, right? Let's just move forward a little bit. As we broke up above it, I went a little bit too far, but as we kind of pushed up above it, I think we came back a little bit to it, did we? No. Anyway, as we moved up above this, I looked at the gamma exposure level and I saw that now this gamma level, this positive gamma level at 6,900 all of a sudden got bigger and became the largest level on the chart, which told me that as we were coming above the previous one, that meant that a lot of call volume was coming in here at this level above, and then we would most likely continue to drift up towards that level. And as you can see, it just drops off. GEX just drops off after that level. So to me, we would come up into that level, and most likely that would be the high for the day. Now, things can always change and shift, and you know the market can do what it's going to do. But based on this information, I thought, okay, now we're probably going to drift towards this highest level, and then when we get there, we might do this, right? But if we get below that, we might do this. Now this is sideways, right? Or vertically, it's not sideways. But as you can see, when we go back to the chart, I've drawn those three levels on the chart. And as we watch price play out, right, we came up and we didn't quite touch that level, but we got close enough. And then we came down through our call resistance level. We pushed through it. We retested it. We came down. We retested it again. Now we came down to this lower level and we've bounced off of that lower level, right? So knowing where these levels are on your chart is really helpful in a support and resistance type way. And just knowing that these are on the chart helps, because generally, you know, this lower level, yeah, you could predict that based on the day's lows, but the upper level, not really. You know, there's no VP level, or there's no like technical level that makes sense other than it's a high gamma exposure level, right? This is a 1 minute time frame. I'm sorry. Yeah, thanks for the question. This works on all time frames, right? And it's not just 0 DTE. So you can look at gamma exposure for, you know, the weekly expirations on, you know, things like Apple, Google, and take the largest values, and they're probably gonna act as a magnet and also as support and resistance levels, right? So right now, these are the levels that the market's playing with. The main call resistance level that was at the start of the day there is now kind of acting as a point of control, and we're moving between all those right now. So we have an upper resistance level, we have a lower support level. I don't know if that's going to help or not. But so far, we've been bouncing in between those, right? So if you like to play snipers or quick turns, these levels are great risk-reward places to take shots, right? Because dealer hedging will bring them down into that level, and then the hedging gets more aggressive, and usually that will result in a bit of a rejection of that level. right? And so there are a number of services that will, be able to give you this information. Unfortunately, all of them are uh, paid services, and it's not super cheap to get GEX information. But what I am going to start doing and just sharing with everyone in the chart, at least on the SPX, is I'm going to mark up the chart like this every morning, and then I'm just going to share it with you all in if you want it. If you don't want it, no big deal. I'm just going to share that chart with you, and it'll have the day's GEX levels on it. And you can see here, if we get into our 0 gamma level, that's where we flip from a positive to a negative gamma environment. And then we have our put support levels, our main put support levels, right? And then our sort of ancillary put support levels. Once price gets into this 0 gamma area, it gets pretty volatile, right? It doesn't normally, it will act as support and resistance on top or bottom, but we tend to get into some pretty violent swings in that area. So if I'm playing snipers, I tend to try and stay out of the way when we're in and around the gamma flip area. Yeah, there you can find a Discord, I think, with free uh, gamma exposure levels, and then you can put them on your charts. There's just a lot of options out there. But I think for those of us who like to trade these 0 DTEs, that it will be helpful to have these levels to start the day. And as I've said before, and as you saw in this chart, the levels change throughout the day based on price action, right? Things are constantly shifting. So that's kind of a big deal. But we can at least start the day knowing where some of those key levels are and placing trades based on those. Now, so there's there's other ways to play this. You can buy and sell calls, sniper style. On this style of trade, you could also, like, if you think this level up here is going to be the max level for the day, right, based on what we've seen on the chart, being that this is a massive level, and then the levels just kind of drop off after that, then you could say, all right, another way to play that is if we come into that major level, we could do a call credit spread, at that level or slightly above that level. And if price doesn't break that level and stays down here throughout the day, then you are in good shape, and you can take that off for profit or max profit, right? Especially if you're playing the SPX. The other trade that I like to do every day at about 1:30, 10:30 my time, 1:30 market time, is I go into, and you've seen us do this a couple of times. I go into, I want to find the chart that will just show you this really quick. Let's see. At like a 10:30, I like to go in and say, here's the chart that was on the presentation earlier. Okay, what is our largest gamma exposure level, and are we in a positive gamma environment? And then I like to say, okay, I'm going to take, unless we're sitting at price, because then it's not quite as lucrative, I like to take a butterfly and or an iron butterfly for a pin at that level. And usually I'll do that for like 10 wide. So there's a little bit of, there's a little 10 wide on each side. So a 20 wide butterfly basically. Basically saying that I think price is going to come back to that, and then use theta decay to my advantage if price comes into that area. And now what I do like to do is you can let an SPX gamma exposure level trade, or any SPX trade, you can let that just go to expiration and it will cash settle, which is nice. But what tends to happen, and you'll see this from yesterday, so yesterday we had a 68.50 pin going, right? 68.50 pin, which is right where my cursor is. I'll draw like yeah, perfect. Yellow line. 68.50 pin, and rolling into the last couple of minutes, 15:55, 56, 15:57, we were just about to close at max value for that butterfly. And right at the last minute, it pushed up, it does this, or it'll push down, and just kind of, it didn't take you outside of the profitability of a 20 wide type butterfly, but it did change from like a $900 winner per contract to more like six or five. So as you get into that expiration, I like to take those off for profit into that last half hour if they are profitable. I just don't love those quick sort of violent moves. The day before, Nate had one on at 68.50, and we were trading above it right until the close, and then we dropped right to it and closed like, I think it was like 9 cents off of it. It was pretty crazy. But so I have a trade going that I just take every day at 1:30, that I just trade the biggest gamma exposure level as long as we're in a positive gamma environment. And I'm risking per contract, I'm generally risking maybe $200 for a $900 win. And it's not a huge, it's not like a 75% win rate, but your risk to reward is so skewed to the better level. Like if they hit or come close to hitting, your profitability is so much higher than your risk. It's a little like a lotto, right? And so today's gamma exposure main level, I mean, it's not 130 yet, but if I were to say, okay, I'm not going to be here at 130, but I want to sort of predict a level in which to take a butterfly type trade today. Hold on a minute, let me pull that up. It would, 68.80 is still the biggest level. 68.65 is coming back, right? So from this previous chart, as you can see, these are absolute gamma levels here. Right here, I'll pull this up and put it on the screen so you can see it. Right, these are absolute gamma levels. Here's the 68.65, which we're currently sitting at. The 68.80, which is above us, is still bigger, but there's still a lot of time. There's ways to see like open interest and daily volume by strike. The 6,900 is getting a lot of volume. But if I had to pick one right now, based on the chart, I would actually probably pick the 68.80 and say that we're going to come back into that at some point, right? And so you can also, here off of this level, if this is support holding, you can take it's a put credit spread, so it's not a gamma exposure trade, but this, I could also see a put credit spread down here. And then take it off, good risk reward if that thing wants to roll over and push down into this zero gamma level. But for me right now, looking at the chart, I think we hold in here, but the market's going to do what it's going to do, right? We have no control over that. We can just take trades based on what we see with the best information that we have, and then make sure we manage those with good risk reward. Yeah, I do it at 1:30 Eastern time. That's just something I've found that has, tends to work okay. Again, it's almost a 50% win rate. So, you're going to lose a lot of those, but you're only risking, if you're doing one contract, you're only risking maybe $200 to so it's almost, they're good lotto style trades, and it's not. And what I like about it is it's not a lotto style trade where you're just like, well, I have no information, but I'm gonna guess that we're gonna close at 6,900, so I'm gonna do a pin for there, and then you don't get it. If we're looking at gamma exposure levels, and we can understand that, we there's it's going to act as a bit of a magnet. Market makers are going to have to bring price back that direction unless there's a lot of action below or above, depending on the direction you're going, and the gamma exposure profile changes. If it doesn't really change, they're gonna have to hedge back towards that main exposure level because they're way too exposed, right? So, we're taking a lotto style trade, but we're doing it based on some pretty concrete information, and we're basing it on information that is what market makers are having to look at and having to make choices based on and hedge to, not just what other retail investors might be doing. Right, the market makers are the ones that really are gonna force that price one way or the other because they need to. And that, I think that information is just so crucial, especially now that the options market is so large and so many people are playing options and so many people are playing zero DTE options, especially, that knowing what's happening intraday is a really big deal, and it just helps inform trades that you're going to be making. So anyway, that's the whole run through on gamma exposure. I'm sorry it took me so long to get that together. I didn't want to, as you can tell, it's a little complicated, and I didn't want to half-ass that presentation. So I just sort of wanted to put some time into it, and it took me longer than I thought it was. Do you guys have any questions based on what I have shown you? Navy Nick, I don't necessarily shoot for a percentage target. I mean, a lot of times with that, if it's a true lotto style trade, I will let it, like if I can't be near the computer, I'll let it expire worthless. I mean, worthless or in profit, whatever that is, because you can do that with the SPX. Then other times, if I think it's going to be close but it feels volatile, like let's say it's an iron butterfly that has a max profit, or I took a credit for, $900. My risk is $250. Let's say, I'm just kind of picking some random numbers. I will, if I have to walk away, but I feel like we're gonna be close. Like the market looks like it's gonna close where I thought it was gonna close. I'll set a profit target for, let's say, I'm gonna take it off at $600. Right, so I'm walking away. If it triggers, I'm walking away from a potential $900 win, but it also has to print. It also has to close exactly at whatever my strike price is for that to be a full $900 win. And so I figure if I take that off at 5 or 6 and just set that as a stop limit order, that it'll take that out when it gets there. And sometimes I've had it go where it's a loser, it's a complete loser, and I've just written it off, but you see a bounce happen, or you see a rollover happen, and it comes close enough to being a in your butterfly wings to take some of that profit off only for a few seconds. If you have that stop limit order in there, or that limited order, I guess it doesn't have to be a stop limit, then you might get filled as it comes through there, like late in the day, even though it might have been a total loss, right? So there's just different kind of ways to play it. Oh yeah, some folks aren't paying for real time charts. Yeah, I would just recommend paying for real time charts. I don't think you need to. There's a lot of. I mean, Thinkorswim is free, and it's not a and it has SPX. So there's a lot of ways to get that information free. Yeah, Pilot Fish. This all plays it. Max Payne is data driven from the options market, which is all of this. This is data driven from the options market. So there are max pain levels. I have found as of late, max pain doesn't really matter at all. I found that, I can find better levels to get a pin on or play off of. And max pain is, 30, 40 points away from that. And it doesn't even come close. So, yeah. Yeah. No, Tony, I can choose the day of expiration. Most of the services that do this uh, are have the ability to look at just that day, look at the whole week, look at multiple expirations. All right, you can look at monthly expiration, gamma exposure, depending on what you're looking at. I mean, for this presentation, I was using SPX only. Toss, Toss has SPX trading in real time. It doesn't have gamma exposure. There are not many places you can get detailed gamma exposure information without having to pay for it. Yes, I will be here for a 10:30 trade today, or 1:30 trade. And I'll start putting those, now that I've done this presentation, I'll start putting those into chat. Just be aware that they're, slightly less than a 50% win rate. So, but the risk reward is usually, very little risk, big reward, but a low win rate, right? So, manage the size of those positions with discipline. You can let them completely expire once they're worthless, but don't put. Yeah, unusual whales is a good one. The two that here I've been using. I was looking at unusual whales, but I've been using these two here. Option Alpha is one. Mentor Q is another one. That has a lot more data. Oh, sorry, that was supposed to be two different lines. Those are the ones that I've been playing with. I like unusual whales. I've been poking around with that a little bit. I might change over to that. There is a free Discord one. It doesn't give you as detailed information as I would like. But yeah, there's every day. Oh, the GEX. I'm gonna do that in the morning for everybody. So when I come in the morning, probably around 9:30. I'll try to get those. I'll try to get those up and posted. And what I'll do is I'll just post a link to the chart itself, and then you guys can just open that up. And I know there's a way also to share a chart, and then if you make changes to that chart, it'll make changes on your end, but I'm not sure I know how to do that just yet. So I'll just share the chart every day. Yeah, I'll do that kind of first thing in the morning, because I'm usually prepping that and I'm taking the 15-minute ORB and then getting my snipers set up to take, after the first 15 minutes. The first 15 minutes is pretty volatile, so I usually kind of wait there. Yeah, so every day that I'm in, I'll post those. Share dog. Yeah, we can talk about all the Greeks. I mean, the theta is the other one that's really important, and that's time decay. And I've done a presentation on that. I posted that on YouTube. That's when we're playing these 15-minute ORBs and anything where we're selling a butterfly or a credit spread. We're letting theta work in our favor. That's decay, time decay. That's the only other kind of important one, in my opinion. There's Vega and Rho. Those don't affect us as retail traders quite as much. So, okay, I am going to jump off if there's no more questions. And then let me know as you start to use this and play with it, if it's working for you, if you want me to make any changes to the way I'm sharing that information. I want it to be helpful for everyone in this room and not just be, more info that's, not helpful. So, I'll be in the room this afternoon if anybody has further questions, and I will talk to you all later.